Hi, my name is Kevin Bass with Bass & Associates, and today we're going to talk about reducing your IRS audit risk in your QuickBooks file. Now, a lot of our clients are privately held businesses and they use QuickBooks for their accounting software, which is wonderful software, but not done properly, you can kind of get yourself in trouble. Reason we're doing this video is the IRS recently, in the past few years, has actually started requesting a full working copy of the QuickBooks files of taxpayers that they have under audit. What this means is they actually get to see exactly what and how the transaction has been entered in your QuickBooks files, and that can lead to some trouble when they issue their audit decision. So we're going to go through 10 tips today on how we can reduce the risk if and when the IRS comes in and takes a look. Okay, first thing, number one, something that's always been a hot issue is subcontractors, which means you're paying an individual that is not an employee. And a lot of things can pop up in this situation. But number one, make sure subcontractors are properly and clearly identified in QuickBooks. Make sure that in the vendor menu for this particular individual, you have it properly set up for 1099 reporting. Now, whenever possible, if you can, if you're paying subcontractors, make sure that check is written, if possible, to a company name or LLC or something like that, rather than a person. All right, if the IRS is going to try to reclassify a subcontractor as an employee and hit you with payroll taxes and penalties and any possibly benefits, they cannot reclassify a company. They can only reclassify a person. So if they have a company name or an LLC or an S-Corp, make sure you're using that name, not the individual's names. And then always good practice, what you're always supposed to do is get a W-9 on anybody that's going to get a check out of your company. All right, second tip, avoid what I call foolish or trite expense memos, okay? When you enter a transaction in QuickBooks, whether it's a check, a bill, or anything like that, be careful what that expense memo says. You don't have to stress out too much, but just don't put anything silly in there. All expenses need to clearly be deductible under what's called Section 162, which covers all the expenses that are allowable on a tax return. So make sure that it's clearly a business purpose. We've had client files, we see all kinds of funny things where they've written a bunch of checks to employees and they wrote Happy Thanksgiving in there and that didn't run through payroll. You've got some other silly names, but just sure that those memos mean business, kind of a rule of thumb. Third, make sure you're not paying any personal expenses out of the corporation. A couple here and there is not going to get you in trouble as long as those are properly moved to shareholder distributions. What I'm talking about is expenses every single month, paying your groceries and your mortgage payment and personal vacations, those kind of things out of the company. Don't make that a regular course of business. If you're occasionally buying your spouse's Christmas, birthday or anniversary present out of the company so they don't see what's hitting online on your personal credit card, you're not going to get in trouble for that. But when you're consistently paying personal stuff, this leads to trouble. Because what will happen is the IRS can come in and say, hey, you're commingling here, and put control risk at the maximum and actually possibly pierce the corporate veil and take away the tax advantage that a corporation can give you. All right, fourth, make sure all bank reconciliations and credit card reconciliations and any cleanups are kept pretty current. The reason is when they're looking at your QuickBooks file, there's a statute of limitation. They can only capture stuff in the latest 3 years or in some cases the tax year under audit. If these reconciliations were done far later, it could pull transactions into the audit, which otherwise would not have been. So keep things current. If you need help from our firm, get a hold of us. But keep things current. You don't want to make the risk any bigger than it needs to be. On that same note, make sure that your QuickBooks file does not require major surgery. That's what we call, that's a nice way of saying a QuickBooks file that's a complete disaster. If it requires major surgery, again, the IRS agent might put control risk at the maximum and dig much deeper than they otherwise would. They would no longer use sampling. Sixth, make sure the revenue and all bank deposits are coded to income accounts. Here's what I mean by that. When an IRS agent comes in, the first thing to do is what's called a cash T. And they simply take your bank statements and they add all the deposits and they compare it to revenue, and they need to be able to tie back to that number. They would back in some deposits in transit or back them out depending on the month. So if you've got a number of deposits that are going to anything but an income account, they're not going to be able to tie to the sales number on your tax return. So make sure they're all going to income and not offsetting cost of goods or some other expense account. Finally, make sure all cost of goods sold account are properly identified, so we get them in the right spot on the tax return. If they see those big cost of goods down in general expenses, it's going to throw the ratios off and might trigger an audit in the first place. Also, avoid using the miscellaneous expense account. Make sure it finds a home. If there's something that you don't understand where to put it, feel free to use the Ask My Accountant or Unclassified account so that we can move it. And it's normal to have a handful of those, hopefully not too many. Ninth, finally have a fixed asset policy. The IRS allows you to expense items on your P&L up to $2,500. Now you don't have to use that limit. Some folks want to just use $1,000 and put everything else on the balance sheet above $1,000. They will allow you to do $2,500, but make sure the big items, $2,500 or more, go on your balance sheet as a fixed asset, so we can report it properly on the tax return and depreciate it. On the flip side, don't be putting $50 items into fixed assets. Just put those down in office expense. And finally, the last big one that triggers so many audits and gets folks in so much trouble is make sure your payroll taxes and sales taxes are paid on time. And properly do it in QuickBooks. Make sure they're paid to the appropriate government agencies on time. So that is our tips for reducing the audit risk in your QuickBooks file.